Hey, what's going on, everybody? It is Wednesday, August 10th. Wow. Just wow. That's all I got to say. And I'm not even talking about the markets rally today, which, as you know, I've been bullish and I've been giving you the bullish outlook because I said, hey, now, we are seeing a condition of net positive fiscal flows that is very positive for the economy, and ultimately it's very positive for the stock market. You have a very large embedded short position in the market. You have a lot of pessimism and negative sentiment and bearish sentiment. I mean, all these things I've been telling you, but I've been focused on the main reason behind my bullish outlook was the net positive fiscal flows. And again, let me repeat what I said yesterday. If you want to learn how to track this stuff, I really recommend you spend the $99 and buy my video course, Understanding the Daily Treasury Statement. I'm going to put the link right here in the description below. It's very simple. I teach you how to calculate these net flows off of the Treasury Statement, which comes out every day at 4 p.m. Eastern Time. And that is like the greatest economic resource that you can get anywhere. It's updated daily. It is literally the checkbook of the United States government with every single deposit and every single withdrawal, just like your own checkbook. And you could see these flows. And we're talking about billions and tens of billions and sometimes hundreds of billions in a single day. So there is nothing more impactful than these flows, on a daily basis, on a monthly basis, on an annual basis. As you know, I completely basically ignore monetary policy. I only look at it in the sense of how I anticipate people to behave, because again, everybody is a monetarist. Everybody is a monetarist, with the exception of, I guess, myself and people who follow my YouTube channel right here. And today, I did the video earlier today, and it's, on the one hand, it's kind of comical watching the behavior. On the other hand, it's kind of, incredible. It is I guess it is a condition of mass behavior. Everybody has bought into this perception that it's all about monetary policy. I've been in this business for over 40 years, okay? I've been a trader, I've been an investor, I've been an exchange member on 4 different exchanges. I'm an economist by education. I have never seen a fixation, right, really to the degree of being a mania, a psychosis, I call it a mental illness, that monetarism has become. It is really, really incredible. And I'm not just talking about the average lay person who reads the headlines and follows whatever is printed in the news. I'm talking about highly educated people. Educated in terms of their schooling, yes, but at the same time, dumb. Closed-minded and dumb. Just to highlight once again, and I don't want to go off on a big tangent about this, I've said it enough, but last week we had a stellar jobs report, clear evidence, if the stock market had not already been giving us evidence that things were starting to recover from 2 quarters of negative growth. That job report was clear evidence of a reacceleration in the economy. You had outlets like, not outlets, but the Atlanta Fed forecasting positive economic growth for the 3rd quarter. We had that huge job number, and monetarists sold. I mean, you don't sell stocks in an expanding economy. I mean, this is just basic. It should be pure logic, but they sold stocks because of that deeply held belief in monetarism. Oh, the Fed's going to have to raise interest rates. And now they had to turn right around today. They were buying it back. How do you invest like this? How is this rational? How is this, a a level-headed, systematic way to go about putting your money to work. It's not. It's complete neurosis. It's a psychosis. It's a mental illness. All right, so much for that. I want to talk about the fiscal flow situation. Like I said back in July, I said maybe even back in June, I'd have to go back and look at my videos, but I said August is going to be a big month. We have a quarterly interest payment that's coming up next week. Today we had a Social Security payment. I said yesterday that regardless of what that CPI print comes out as, I said buy the market on a dip today if it dips down. We didn't have a dip. It went straight up. The Social Security payment, I've said, typically we get a move higher in stocks either the day of a Social Security payment, because that's a fairly large net flow into the economy, or we sometimes see it on the second day. We got it today, but we got the boost off of the unchanged CPI print. Next week we'll get the quarterly interest payment. I will repeat once again that in September, mid-September, September 15th, we will get a quarterly corporate tax payment that is due. That is negative. That is a drain. We will see a 100, maybe a 110, 120 billion drain, and that will put us in a correction from like mid-September into probably mid-October. But that is not, you know, a new bear market or anything. That's a seasonal thing. We are back on the expanding, what happened is, like, and I said this earlier today, the economy had to adjust from the slowdown in fiscal support from the COVID stimulus days of, 2020 and 2021. We're back to now what is more or less, I'm going to say normal, but it's still huge. We're running at like 500 billion a month in net in leading flows. Those are leading spending flows. Prior to COVID pandemic, like when Trump was the president, we were averaging like around 420 billion a month in leading spending flows, and that was enough to keep the economy growing at 2.5%. Now, even with the cutback in the fiscal support, and don't forget, they just passed this new bill, which I think is like a 700 billion, but it's not all at once. It's going to be rolled out over a period of years. But that's going to add to it. But even now, running at 500 billion a month, or, maybe 530, something like that, you're still talking about a 25-30% increase over the Trump years. And the Trump years, again, that was enough of a leading spending flow to give us 2.5% economic growth every year on average. And so that's fine for stocks. And by the way, that rate of economic growth, that's gonna bring inflation levels down. So we are now, this month in August, with 7 business days in, we are at a 99.3 billion deficit. That's about on track where we were same time last month. Last month we finished with a 176 billion deficit, and I said that was the reason for the big jump in payrolls. Okay, that positive fiscal boost, that was the reason. We're on track. We're going to exceed it because next week we'll get like a 45 billion interest payment. So this month we could see something like a 225 billion deficit for the month of August, which would be the largest since February. That should put us up to, I think it should put us up to at least the March highs in the stock market, if not higher, okay? Last month I said, when we were still a long way from it, I don't know, we might have been around 3,700 on the S&P. I said my target is, my initial target is 4,250 to 4,520 on the S&P. Well, we're knocking on the door of 4,250 right now. So that's not going to be a problem. I also said we're going to take out the June highs, and we did that too. Okay? So everything is lining up as I said it would. You know, this is the focus. We look at the fiscal flows. It's funny because some of these diehard monetary, I mean, they're really, really upset and they're really, really angry. And I think some of them today, it was kind of like high level emotional, psychological discord. I mean, they just kind of went quiet. They were, you know, they got hit hard and they're got to wrap their brains around it. But I saw some comments to the effect of, well, it's because the Fed hasn't started QT. Well, the Fed has started QT, but it's well below what they initially stated was the target. But here's the irony of that, you know, and this goes back all the way back to the beginning of the year. I was saying this, that I can't wait. I mean, back in January, February, I was saying I can't wait for the QT in the second half of the year, because everyone who thinks that's going to be negative and a drain, right? QT, the irony is that it's going to just increase the acceleration in the growth of the economy. And that's because, you know, the Fed needs to drain some of these reserves. These reserves in the banking system are a hindrance to bank lending. Okay, remember, reserves are assets. They factor into the calculation of leverage ratios. When the Fed dumps trillions of reserves onto bank balance sheets, you know, that just clogs up their balance sheets, and they have to have, in some cases, more capital, or they have to slow the rate of accumulation of other assets, maybe being loans. So QT, in the sense of how it's going to bring down reserve balances, that's just going to boost lending capacity by the banks. And so it's just going to be another shoe to drop for the monetarists. That's going to blow their minds, folks, as if the rate hikes right now and the rising stock market, I mean, you could see their brains getting short-circuited big time. I mean, they're pissed off. They are angry. The ones who muster up the strength, the energy to make comments on Twitter, you know, a lot of them have just, you know, they're down and out. I mean, they got to go recover. They got to chill, because they're just blown away emotionally and psychologically. But the ones who are able to gin up enough energy and courage to make a comment, their comments are hyperbolic. They are furious. They are so mad. Like, hey, man, we've had all these rate hikes, and what's going on here? Like, this should be happening. Like, you know. Anyway, so forget it when the QT starts. I mean, you ain't seen nothing yet, believe me. When the QT starts, you know, and then the economy is growing at 4.5% a year because bank credit is just booming. I mean, I don't know. These guys are just, they're going to have to be committed to some asylum somewhere. But don't expect the monetarist, cult, fixation, I don't even know what to call it, psychosis, you know, insanity to end. They're just going to double down and triple down on. But that's good for us. That's good for us. I mean, you know, we want that because, number one, make money from that. You know how they're going to behave. You know they're not going to understand it. They're going to see it in the wrong way, in the reverse. And number two, it's fun. It's amusing. I mean, it really is. At least I find it to be amusing. You know. So anyway, that's it for today. Nice day. You know, we'll get pullbacks. I mean, don't chase after it. We'll get pullbacks. And, but everything is on track. You know, we've seen a one-time event, which was the decline in overall fiscal support from the COVID years, you know, 2020 and 2021. Had to stabilize from that. And then we got hit at the same time with the April tax collection, and then the June quarterly corporate tax payment. And so, like, you know, it was like a 1-2 punch. It was like a 1-2-3 punch. Looked like a knockout, but you know, the economy's kept picking itself right up off the floor, and things are starting to get back on track. And you don't sell growth. You don't sell growth. I mean, you do if you don't want any money, but that's up to you. Anyway, that's it for today, folks. See you tomorrow. Bye.